Hi, I'm Tony Edward. I'm the author of the book Rethinking Crypto and the host of the Thinking Crypto podcast. And you are watching Taking Stock.
Time to rock and roll. Welcome to the broadcast. One and all, 2 minutes to go here into the closing bell on the trading floor of the New York Stock Exchange, and 1 day to go until Game 2 of the NBA Finals.
Go Knicks!
Go Knicks!
Go Knicks!
15 rebounds for Villanova's own Josh Hart. He today is still the second most popular man in New York City. The number one most popular man, Peter Tuchman. The Einstein Wall Street joins me now.
Never changes.
Not quite all-time highs for the S&P today, but for the Dow, very strong outperformance from financials. What did you see in the close?
You know what? It was kind of a strange close. It was really trading sort of fragilely in a way. I mean, you could see it. It couldn't get a lot of its oomph back. It got up to like up 39 on the handles on the S&P and then kept fading. So it's trading in sort of its range bound. Obviously, the Dow is leading the way with Goldman and some other things. Yesterday, you and I spoke, and it felt to me that it was some profit taking going on off of the irrational enthusiasm in the market. Today, I kind of came in and thought there would be follow through on that, but this market is, look, it baffles all of us at this point, at these levels. It's like as frothy as a Starbucks, cappuccino, in my opinion. But it still keeps going higher.
Yeah, we also have that crucial jobs print tomorrow for investors to digest. That could go any number of ways.
It could go any number of ways. And we don't know if the market's actually going to react to it. Because the last couple of economic numbers have not had major impact on markets. People are just doing what they want to do. And the market's doing what it wants to do.
That's it. That's for you, my friend. The great Einstein of Wall Street.
Go Knicks, let's go!
The closing bell. Another history-setting day, at least for a few of the major market indexes, with the Dow Jones Industrial Average. I got to check my number. 51,562, good enough for an all-time high. The S&P 500 in positive territory on this Thursday, June 4th. 0.4% will miss its all-time high, but not by very much. The New York Stock Exchange Composite Index up on the day. Oh yeah, that is a record close. 23,573, and the small caps up 1.5% to finish the day at 29,3533, just off its all-time high. Healthcare, financials, real estate, the strongest performing sectors in the S&P 500, with your laggards tech, materials, and staples. The big tech stocks not really having to do the heavy lifting for the tape today. We'll talk to our first guest in just a moment about that and much more. Over in the Dow, UNH, Goldman, Merck, your Dow outperformers, your laggards, Verizon, Honeywell, and Coca-Cola, all 9 of the most weighted names in the Dow in positive territory, none bigger than Goldman Sachs, up 5% on the day. The dollar discounters, however, taking a hit with shares of 5 and below down about 12%. Memory stocks taking a hit, as did biotech, home builders, and defense and aerospace. Our first guest, Dave Mazza, joins us now. He is the CEO of Roundhill Investments. Dave, it's good to see you here today. So markets here at all-time highs. Tech not doing the heavy lifting. It's healthcare, it's financials. What do you see on this tape today?
Yeah, it's interesting. We saw a bit of a reversal from, of course, the trend that we've been seeing pretty hard now for essentially since the past 9 weeks, where tech stocks are the laggards. But we did see a bit of a recovery here, particularly, you mentioned UNH and Goldman Sachs, two stocks that sort of have been looking for some leadership here. So I think at the end of the day, it's still an idea that we're not necessarily setting up for a rotation. It looked like this morning a bit more of a degrossing, people kind of selling off winners and maybe covering the shorts that we've seen. But net, dip buyers stepped in again to powering the Dow to all-time highs.
And you look at the most weighted names in the Dow: Goldman, Caterpillar, Microsoft, UNH, Amgen, Visa, Amex, Apple, and JPM, all in positive territory. Helps explain those new records. Dave, we are 2 weeks out, 2 weeks from yesterday, from the next FOMC meeting. What are your expectations for that Wednesday, June 17th, and the final 4 Fed meetings after that?
Yeah, of course, we got the jobs report, as you mentioned earlier, coming tomorrow, which is going to be another data point. But of course, this has really been an inflation story, right? And, the Federal Reserve, even with the new chairman, is in a bit of a rock and a hard place. We know there's significant dissents, both for cuts and then hikes that are coming. So I think this first meeting is probably likely going to be a bit of a non-event. And the majority of rate cuts have come off the table. The market's now forecasting a bit of a hike actually for the end of this year. I actually don't expect to see much. I don't think there'll be much fireworks outside of the press conference itself. That's really where I think people are going to try to ascertain where the direction of travel may end up. In the absence of that, the market hasn't really been pricing too much off of the fact that these cuts have come off the table. Really been focused on sort of the resiliency in the consumer, and particularly the resiliency we've seen in corporate earnings, and then the guidance that we saw, especially for AI-related companies.
I want to get your take on AI as a supply chain story right now. What are you tracking on that, Dave? You think other people would benefit from also paying more attention to?
Yeah, to me, actually, that's kind of the biggest trend that we've seen with the AI trade is it's matured, right? It's no longer just being priced on companies saying they're doing AI or really just looking at the hyperscalers. The market's now going much more down chain to identify where are these bottlenecks in the build out and where actually is this $1 trillion of CapEx going to go. It's not necessarily just going to the hyperscalers themselves. They're the ones spending the money. And so it's going to interesting areas, right? We know one of the hottest trades in the market today, a bit of a sell-off, the memory chip makers. And there's a reason for that, right? That is a chronically undersupplied market right now. Demand is through the roof because of AI data center buildouts. But it's also come other interesting areas related to that, right? So you have photonics, optics, neoclouds. All of these sort of are, in some ways, nascent themes, but also where the real spending is going. So for investors kind of looking at where this next leg can go, even though many of those stocks have run up, it's still where we see the most kind of some of the most earnings excitement coming.
Earnings excitement to say the least. Dave, good to see you. Thanks a lot for being here. All right, we'll now bring in the top analyst calls. If we got the room, I think we do today. Yes, top analyst calls that move the tape today. First up, Jefferies upgrading RTX to a buy from a hold rating, saying it likes the company's situation for free cash flow right now. Shares up on the day, but still down about 2% year to date. Next up, BofA reiterating Alphabet as a buy. Thank you all, saying it's sticking with the stock following its big capital raise earlier in the week. Finally, Wells Fargo reiterating Microsoft as overweight with increased confidence in the stock. Microsoft, easily the worst performing Mag 7 stock so far year to date, down 11%, but up 20% in the last couple months. All right, let's take a look here at shares at UNH here, Todd. This is one of the big dogs in the Dow, and one of the big dogs down here on the trading floor of the big board, getting an upgrade, I should say, from BofA to a buy rating, saying the stock is simply too attractive to ignore at these levels. UNH still well off its highs from 2024, but quietly up 20% on the year. It's the fifth best performer in the Dow so far in 2026. All this week, we are bringing you full coverage from Money 2020 Europe in the great city of Amsterdam. FinTech TV's Anastasia Kinsky sat down with Val Guy of Kraken to discuss the intersection of DeFi and TradFi, plus, of course, a lot more. Take a look.
Welcome, I'm Anastasia Kinsky and we are at Money 2020 Europe in Amsterdam. I have the pleasure of being joined by Val Guy. He is the general manager at Xstocks, which is part of Payward, which is part of Kraken.
That's right.
Thank you for joining me. Tell me a little bit, you've just arrived at Money 2020. What are the buzzwords that you're hearing? What is the top topic?
I mean, it's been exciting walking through. I literally just walked in maybe a couple hours ago, and what I'm seeing is that the real focus seems to be on the intersection of DeFi and TradFi, which is something that has been building towards this. And with maybe I've seen some of this before in previous years, but this year seems exceptional,
Right.
And that's very exciting.
It's really interesting to see that because, as you say, we've been talking about it a lot, but we're seeing some real value moving around now. Tell us a little bit about what you do at Xstocks.
Yeah, absolutely. So Xstocks, actually a really simple product. It's a tokenized equity. It is a token that is on-chain, composable on-chain, transferable on-chain, permissionless, right, that is backed one-to-one by a traditional equity. So every token has one share of the underlying equity that's pledged to it.
I think I want to jump straight into exactly that point because it's a really confusing topic lately. There's been so much excitement around tokenized equities. There's also been a lot of excitement on, other versions of a tokenized asset that is meant to in some way represent a company or a share of a company that's public,
Yeah.
a share of a company that is not yet public.
Yeah.
It gets mixed in with the conversation around prediction markets and,
Sure.
and IPOs. Tease it out for us a little bit so that we understand the landscape and what that actually means to an investor.
Yeah, absolutely. Like you mentioned, there's a lot of excitement around RWAs, real world assets being on chain. And a lot of that is happening within the financial space, within equities. They're kind of the natural product to bring on chain because of what bringing on chain supports, things like composability and 24/7 secondary trading, things like that. The challenge is that you have many different flavors or iterations of these products now. And within sort of the sort of startup space, you're looking at companies that are trying to bring financial products on chain, and they're trying to see what are the products that consumer retails really want. The challenge being that sometimes these products are complicated and it's not well explained to that end retail consumer.
Right.
And so you have this proliferation of products where maybe someone's not fully understanding the risk that they're taking on, or it's fragmenting liquidity in some way. And that is making definitely a little bit of a potentially confusing world for that end retail customer especially. Generally, we think that more products is better. You give people the ability to have options,
Yes.
which is generally very good.
Yes.
But it has to go hand in hand with that person understanding what it is that they're purchasing. And I think that's where the space is just still so young. It's just not being done very well yet.
Yeah.
You look at something like XStocks, we try and keep it as absolutely simple as possible. One token is backed by one equity in all cases. Very simple. That's not the case for some of these products. Like some of the pre-IPO products, unclear if the underlying actually exists or whether or not they can actually be transferred.
Yes.
There's inherent risk there. Some of the other tokenized equity products, they're not sort of backed in a sort of official manner by having that sort of underlying equity and working with the right institutions to have that right backing. And so that's where things can get confusing.
And I really hope that Money 2020 great conference for you.
Wonderful.
Thank you for joining us.
Thanks for having me.
Retesting, that's February 6th. Welcome back to the show. Time now to talk to our second guest. This is David Mickley, head of Americas at Wintermute, one of the largest crypto market makers and providers of liquidity in the general space. Nice to see you here. Thanks for taking the time.
Thanks for having me. It's great to be here.
All right, so you and I were just taking a quick look here at the Bitcoin chart. What are you seeing in terms of this pullback? Is this kind of garden variety, or does this one feel a little bit different to you?
You know, it happens all the time, but every time it happens, it feels like it's worse than the times before. And there's a lot of things that go into this short-term pullback, but long-term, there's still a lot of reasons to be bullish. So am I worried? No. Is this part of being exposed to a volatile emerging asset class? Yes.
What are those reasons to be bullish? What is your bull case right now?
Absolutely. There's a lot of things going for the crypto industry in general and the Bitcoin asset in particular. So first of all, the amount of ways that distribution is being unlocked every single day is expanding. Just recently, Morgan Stanley issued a new ETP, 16,000 financial advisors that can distribute Bitcoin to Morgan Stanley clients. In the future, Charles Schwab is looking to expand their offering as well. The Clarity Act, that will be the big unlock. A lot of uncertainty on how that's going to go, but a lot of institutions are still on the sideline waiting for the Clarity Act to pass.
So why have we seen the separation between, I love this question, because I think it's really important for context when people see the headlines. Why do we have the separation between institutional adoption on the one hand, falling price of the asset on the other, or does that not even matter?
You know, it does matter in the short term, but in the long term, I think it doesn't. If you're investing in Bitcoin, you have to be willing to ride the highs and lows and not sell when it goes up and not sell when it goes down. Just hold for the long term. Why the decoupling now? There's a few things. First of all, the equity story has been strong and it's tied to an AI boom that is boosting earnings. Crypto doesn't have that advantage. Bitcoin doesn't have that advantage. So there's all sorts of macro headwinds that Bitcoin is exposed to, which other assets aren't isolated to in the same way that crypto is. That's one factor. Another factor is simply the leverage in the system. It just makes moves in bigger directions. And the down days feel more painful, that the up days feel good, and that's what people are feeling right now.
I also love the conversation in ETF inflows and ETF outflows. What have you seen in that space as of late you think is worth it for the rest of us to pay a bit more attention to?
Oh, absolutely. I mean, ETF outflows have been record-breaking in a bad way, right? You look at the 7-day, 10-day, 20-day outflows, record-breaking. Over $4 billion in outflows over the past few weeks. That's massive. But the reason those outflows are possible is because there were so many inflows in the months and years before. So the inflows ultimately lead to outflows, but what matters is taking a step back and looking at the big picture, and it all comes back to net flows over the long run. And the more distribution there is, the more plumbing there is for more investors to get access to this asset class, the more opportunity there is for flows to come back.
I don't have much time, but I do want to ask you about Wintermute's efforts to expand into prediction markets. What do you see in that space right now?
Yeah, Wintermute is used to expand into new markets. In 2017, crypto was an early market, and we brought our liquidity providing expertise to make that market more efficient. We see prediction markets as the next frontier, as a way for investors to isolate certain elements of data of financial markets that they want to get right without being exposed to other elements. And it's a natural fit for us given the fundamentals of blockchain technology used on a lot of these prediction market platforms to leverage our liquidity providing expertise on these markets.
David, well done. Come back anytime.
Thanks
Good
a
to
lot.
see you.
Great
Don't
to
go
be
anywhere.
here.
A lot more Taking Stock coming up live from the big board after this. There you go. Dude, really good, dude. Awesome, dude. Oh my God. Welcome back to the broadcast, live from the trading floor of the New York Stock Exchange. Andrew Wang joins us now, the CEO and co-founder of Valen, a mortgage servicing company and a major player in the world of software platforming. Nice to see you here today.
Thank you for having me.
Thanks for taking some time for us. So talk to me about why AI adoption inside big financial institutions seems to be moving as slowly as it is.
So I think there's a couple of really large components. One big component of it is ultimately security and compliance. There's a big amount of risk and worries that a lot of large financial institutions have when it comes to adopting AI and making sure that it's keeping their information private and it's holding it in the right places. Then there's, I think, a different component, which is there's just a much higher degree of scrutiny around regulated services, right? If you use AI and it says, hey, I'm going to foreclose upon this home, probably doesn't really check out, doesn't work, versus if you had deterministic rules, which is how it used to work, then you have some level of a guardrail and psychological safety. And so I think the evolution of regulated services when it comes to AI just will take a very different and probably slower path than what we're seeing in, for example, engineering and coding and things like that.
That's a fascinating distinction. What would you say are among some of the largest misconceptions about AI adoption right now?
I think the biggest misconception today on the tech side is just how fast it'll move. I think it'll take a lot more change management and teaching people how to use the underlying product, because so much of it ultimately is a matter of skill and understanding and really just changing how you work as opposed to just automating specific processes you used to do. I think that's a really, really big component. I think another misconception on the financial services side and really the old school side is just how much can be done, right? There's a continued belief that AI, while it's really powerful and great, is still just ChatGPT, not Claude Code or whatever else that people use today. It's way more powerful than they imagine. I think those two worlds can be true at the same time, but they need to meet in the middle.
And I've heard a lot of people have this conversation, maybe ask this question, I wonder how fair it is. Am I training my own replacement? How legitimate, how fair is that concern from people in the space?
I think it's fair if you think you're never going to change what you do, right? The perfect example here is always, hey, if I used to, be someone who does typewriting and I, make mistakes here and there, but I've trained myself to be a very good typewriter so I can write these things with high proficiency and high speed. Well, now it turns out that with computers and with voice AI transcription, you can write a lot faster. Does that mean you're training your replacement? Yes, in the sense that your job, literally what you were doing before has changed. But no, in the sense that perhaps your job actually was to take the messaging, the thoughts of whoever you're working with and communicate more clearly. So it really just depends on how you view your job. And if you think about the evolution of that, then you're never really going to lose that.
Why is mortgage servicing such a difficult test for where artificial intelligence is right now?
So when it comes to AI and a lot of the underlying technology, it's been trained on the vast corpus of public knowledge and information. Mortgage servicing is a perfect example of where there's a good amount of public knowledge, but there's a tremendous amount of in-house tribal industry knowledge, which is just not available in the public domain. There's a lot of it that is written down in the lores of how you do mortgage servicing, the crisis, whatever else, and that is a very hard thing for AI to interpret and a very hard thing for AI to extract. It is a perfect example that where if you've built all of that context in that domain, you can automate a whole lot more, but nobody's built that repertoire and corpus of knowledge.
Andrew Wang, CEO, co-founder of Valent. It's really nice to see you. Thanks a lot for taking the time. Awesome interview.
Thank you very much.
Come back anytime. Don't go anywhere. A lot more Taking Stock coming up right after this. Nice. Very good.
Thanks.
Welcome back to the show, and now a sit-down between FinTech TV's very own Anastasia Kinsky and COO Jody Mettler of BitGo from Money 2020 Europe in Amsterdam. Take a look.
Here we are at Money 2020 Europe in Amsterdam, and I had the pleasure of being joined by Jody Mettler, COO of BitGo. Thank you so much for joining me, Jody.
Wonderful to be here today.
So you became one of the first crypto IPOs of the year in this January at New York Stock Exchange. Tell us a little bit about how that changes the way that BitGo is providing services for their clients.
Yeah, absolutely. It was such an exciting day at NYSE. It was wonderful hosts. Yeah, being the first of this year in the digital asset infrastructure, we saw a couple go last year. Being the first this year, it was important to us. We have been building the company for the last 13 years as a private company. We have grown into our own skin as an infrastructure company, and the next step for us to that credibility, that next level of having conversations with that tier of companies is to be public. So it's great.
It's very exciting news. Speaking of those clients and where they're based and how you've seen the industry develop as a whole, I've had a little bit of narrative here of like sort of, you know, where the innovation is happening. Is it very US based, very Europe based? Is there a race between the two jurisdictions to build that infrastructure? What are your thoughts on that?
I definitely think that the innovation's happening in both places, right? You have fintechs that are building the bottom line technology. I think it's less about where that's happening and where the regulation is happening. And I think, there's a race happening between the two, but I don't know that it's a competitive, one's going to be, if they're first, it's better. It is more about making sure that the clients within those jurisdictions are enabled.
Yeah, definitely. And speaking of that being enabled, the industry has been screaming for some global harmony on the regulation for a really long time, long before regulation was even being drafted. And what are you seeing as we're finally getting there on the major jurisdictions having their own frameworks? How are you feeling about how things are diverging, converging? You know, are we getting to the point where we can feel confident in that sort of regulatory harmony?
Yeah, I mean, the EU has actually been really forward thinking about this. MiCA came in, was the first harmonized regulatory structure for digital assets. The US is still working on it. We had Genius last year. We're hoping for clarity this year. These are borderless assets, right? So they want to be able to move settlement and transactions and liquidity across borders. What I am seeing is the EU has absolutely taken the forefront of regulation, but some of the companies here are slower to adopt and be comfortable with it, particularly the traditional companies.
Right.
Similar in the US as well. They're waiting on the sidelines for that regulation to pass, and then I think they'll enter. And then what I'm seeing from other jurisdictions like APAC is they're following the lead of these big jurisdictions. So once you see MiCA pass or Clarity pass, I think you're going to start seeing that more borderless regulatory framework.
Yeah, and that would imply that everyone is sort of falling into line, which is a nice thing to see. And so what we can therefore expect as everything falls into place, perhaps a surge in activity. And certainly here at Money 2020, we've seen stable coins, tokenized assets move from the narrative of this is just for the digital asset space through into actually this is part of the full plumbing of the financial infrastructure. What do you see as that shift, and what is the role of BitGo in that?
So BitGo is an infrastructure company. We've been building off of initially a wallet infrastructure, and then we built a regulated custody business on top of that, and then built financial services on it. So we want to be able to have clients come in and plug and play into any part of that infrastructure. What we've seen, and BitGo does stablecoin as a service. So we help our clients actually issue their own stablecoin in multi different ways. What stablecoins did this year is really legitimize that you can move cash on chain. And now it's the tokenized assets. So now you're going to see, and you're seeing it already, money market funds, equities, those types of things. They're really exciting. So I think that's the next current wave that's happening. And then from there, you're going to start seeing tokenized real world assets. And I think that's maybe a year or two down the line, but you have to prove it out first. And we've proved stable coins, BitGo is part of that infrastructure. Now it's going to be tokenized, more liquid assets.
So thank you so much for joining us and talking to us about BitGo.
Yes, thank you.
Enjoy the rest of the conference.
Thank you.
Tomorrow morning here on Wall Street, we will get the latest jobs numbers for the month of May released by the Bureau of Labor Statistics at 8:30 a.m. Thank you for watching today's edition of Taking Stock. Have yourself a great Thursday night. We'll see you again tomorrow. Yeah, Robbie!